At the monthly close last day of November, gold price, the spot gold price, closed above $2,000 for the first time ever. Okay, that was pretty remarkable. And as I said, the very next day was Friday, December the 1st. The daily and the weekly chart closed at its highest price ever. December, typically pretty strong month seasonally for a number of reasons, which we can get into if you want or not. Just to understand it typically is. This is a very strong time, December into January, seasonally for gold prices. So there's reason to think we could still bounce back, turn the monthly candle green, and finish the year with a new monthly high for spot gold, a new quarterly high, a new yearly high, closing high for gold.
Gold is close to securing a major breakout above $2,100. Once confirmed, we expect a robust bull run, taking prices towards $10,000 by 2030. This week's Fed pivot was incredibly bullish for precious metals, and we see gold reaching record highs in the coming weeks. In this video, CraigHemke, renowned for his insights and analysis at TF Metals Report, anticipates spot gold reaching record highs by year-end, leading to increased attention in the gold sector. Notably, he points out a historic moment in November for gold, while foreseeing a rally towards $2,300 before the summer of 2024. Gold carries its bullish potential into early 2024 on prospects of a looser Fed policy, lower U.S. bond yields, and a weaker U.S. dollar. However, a downturn in the global economy could weigh on demand and limit the gains of precious metals. Moreover, Craig states that gold has had an impressive historical average gain of 99.3% since 2000. Despite an 11% increase this year, he urges watching December's monthly close, traditionally strong for gold prices. In 2000, the price of gold was at its lowest since 1990, with a troy ounce of gold costing $274.5 US in that year. Since then, gold prices have been rising, and after the economic crisis of 2008, the price of gold rose at higher rates than ever before as the market began to see gold as an increasingly good investment. He parallels 2010's superfecta, where gold's record-high closures led to a substantial 25% rally in the following 8 months. Now, we present the clips of CraigHemke's insights from his recent interview with Liberty and Finance. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
That breakout that we've been waiting for the last 3.5 years, it's funny, there are, I don't know, I guess technical analysts, people that are permanently bearish on gold that sit there and they go, oh, look, it's a double top, it's a triple top, it's a quadruple top. Look, there's no such thing. I mean, there's a double top, there are double bottoms. Everything after that, you're just in a trading range, and gold has been in this range since, I don't know, August or September of 2020. I mean, clearly defined. At which point, every short contract ever created was underwater at the close on Friday, December the 1st. So it's no surprise that it shot higher and then went right back down, creating that kind of ugly reversal candle. But I do think we are poised to eventually break out on a permanent basis. And when that happens, typically, again, in anything that's been a trading range, it generates headlines. Gold will generate its own headlines. Oh, look at gold now, above 2,100. And you'll get another rush of speculative money. Not maybe, we won't go to 2,300 in a matter of days, but over a course of a couple of weeks, we probably will. And that's what I thought would happen at some time before the end of this year. And so since we're about 6 months behind schedule, I feel comfortable thinking that's going to happen sometime, before summer of next year. Now, it'll be interesting to see where we go from there. And I haven't fully thought that through yet. But anyway, back to the metals and where they are. As you and I speak, gold is up about 11% year to date. Anybody can cherry pick, date ranges. But if we just go back to 2000, this century, on average, dollar price gold gains about 9.3% a year. So, okay, we've had a slightly better than average at this point. The thing to watch, though, now, as we go into the last, what do we have left? 7 or 8 trading days, maybe? Maybe not even that many, 6. Anyway, the thing to watch, at the monthly close last day of November, gold price, the spot gold price, closed above $2,000 for the first time ever. Okay, that was pretty remarkable. And as I said, the very next day was Friday, December the 1st. The daily and the weekly chart closed at its highest price ever. December, typically pretty strong month seasonally for a number of reasons, which we can get into if you want or not. Just to understand it typically is. This is a very strong time, December into January, seasonally for gold prices. So there's reason to think we could still bounce back, turn the monthly candle green, and finish the year with a new monthly high for spot gold, a new quarterly high, a new annual yearly high, closing high for gold. And all of those things combined to turn the generalists onto the sector. I remember when this happened only once before in the 13 years I've been doing this, was at the end of 2010. Gold wrapped up, whether it was New Year's Eve or whatever day it was, on 2010. Gold finished that year, daily, weekly, monthly, quarterly high, higher than it's ever been. And I called it a superfecta, for people that are horse racing fans. And then what happened? The first 8 months of 2011, gold rallied about 25%, as this kind of general rush of funds came in. So let's watch that spot price, that gold price over the next 5 or 6 days, see where we finish up at the end of the year. And that might tell us a lot about where we're going the first half of 24.
CraigHemke discusses how inflation erodes dollar purchasing power faster than the rising stock market, affecting real returns. The purchasing power of the U.S. dollar has steadily decreased over the last century. That's what inflation does to fiat currencies, like the dollar over time. Meanwhile, Craig acknowledges silver's limited returns, but underscores the enduring impact of inflation on the Federal Reserve's strategy. As of April 30th, 2023, in the last 5 years, silver has given returns of 13.1% versus 12.3% by Nifty 50 and 13.0% by gold. In the last 3 years, silver has given returns of 20.8% versus 23.8% by Nifty 50 and 8% by gold. However, he predicts a potential crack-up boom scenario where continuous money printing, particularly by the Federal Reserve, may lead to hyperinflation. The Federal Reserve Bank is printing a record number of $50 bills as Americans feel the urge to hold physical cash. The Bureau of Engraving and Printing, the agency in charge of money printing operations in the U.S., created 756.09 million new $50 bills in 2022, reports CNN. Let's get back to the interview.
You're kind of talking about real returns there, that you're losing purchasing power faster than the stock market's going up. And that's always something, people should keep in mind when they look at any investment. I mean, you could certainly say silver hasn't helped us much in the last 10 years in terms of maintaining, real returns. But so that's always something you want to keep in mind. Inflation is probably here to stay, no matter how you measure it. And to a great extent, the Fed needs that. When we got to a massive 125% debt to GDP ratio coming out of World War II, and the Fed managed that back down by sharply negative real interest rates and printing a lot of cash so that you're paying off yesterday's debt with the devalued dollars of tomorrow. And they're going to continue and even put more effort into playing that game going forward. Because, again, can't emphasize enough. I mean, we're at, with the 10-year Treasury at 4% or whatever it is after peaking at 5%, and the 2-year notes, still up there at 4.5%. I think even just in the next 90 days, we have some $6 trillion worth bills and notes and bonds that are either being issued brand new or are coming due and having to be, pay off the old holders and issue new ones. There's $6 trillion worth, so somebody's got to buy that stuff. I mean, that's how that reverse repo has been drawn down. That cash has come out, gone into the bond market, to hold rates steady and drop it back down. But at some point, someone's got to buy that stuff because we cannot afford to have no bids. All of a sudden, Treasury's yielding 6 or 7% because the interest on the national debt is already at $1 trillion. We're at 34 some odd $trillion total debt. The rates double from here without the debt even going up. We're talking $2 trillion. Well, and now, I mean, the deficit's never coming down again. The whole thing spirals out of control in the end of that Keynesian experiment that we're talking about. So I feel very comfortable, as you can tell, in projecting where the Fed is going with all this. They've proven since the paradigm changed in 2009 that that's what they will do. They will print and come up with new rescue programs and everything else just to, to keep the plate spinning. And I'm sure that's what they'll do next year, too. We're on the verge of that what people used to call the crack up boom. the central banks, most notably the Fed, have to just keep printing so much money to keep the plate spinning. I mean, it costs $1 trillion now a year just to service the existing net U.S. federal debt. So they have to keep printing money. And when that reverse repo thing runs out, where's the liquidity going to come from? I mean, they're going to have to keep printing the cash. That cash ultimately flows into, investment assets, risk assets. Go back and look, some of the best performing stock markets in history have come in hyperinflationary, the central bank is just printing cash like crazy. So there's always short-term risks and pullbacks. But I've been in that camp now, this crack up boom, for about a year and a half. And again, that's where it looks like we're headed. You and I have probably also discussed that as long as the biggest fear in the stock market is not the fear of losing money, it's the fear of missing out. As long as that stays the same, then dips are going to be bought, regardless of the valuations, and the PE ratios and all that kind of stuff. So I think it's likely, again, stock market, maybe it'll go up a double top at the old highs from 2 years ago. But man, if it blasts right through there, it's going to generate a lot of headlines like we're talking about with gold. So there's probably room to maintain an allocation toward equities in general. But again, it's not going to be just a straight up ride. There's always going to be sharp rallies and sharp pullbacks.
Gold set a new all-time high in 2023 and rose more than 10% on a yearly basis. Western investors' interest in gold increased its rate from a minimum of $1,160 in the summer of 2018 to a record high of almost $2,073 in May 2023. During this time, the precious metal has become one of the most attractive financial assets on the planet. What are your thoughts on the future of precious metals, and how do you see these factors shaping the broader economy? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.